Hi, it's Amanda DeVito Parle. Welcome to my podcast, At the Kitchen Table, where we will guide, inspire, and connect. So welcome to At the Table, our podcast about real estate, where a lot of real estate gets done at the kitchen table.
I like that name, At the Table.
At the kitchen, yeah, nice. Right, yeah. And so the idea is that we would guide, inspire, and connect people. So I have Tracey Wilson at IPX 1031 Exchange.
Yes.
And so thanks for coming.
Well, thank you for having me.
You're welcome.
The full name of our company is Investment Property Exchange Services, Inc. You can see why we're big mouthful of a name like that. We're trying to shorten it up to just IPX 1031. So Either name works for us.
I want to go back because I would like for you to help me understand what it is that your company does.
Sure.
How you came into this business. Tell me a little background about you, where you came from, and then what a 1031 exchange is and what IPX 1031 exchange does.
Sure. I'll work backwards a little bit of what you just asked me. Section 1031 of the tax code allows someone that owns investment real estate to sell that property, whatever it might be, rental house, rental condo, raw land, a farm, commercial office building, whatever, and then defer or roll the gains over into the next property that they buy so that they don't have to pay the capital gains taxes, which can be as much as 30%. So that's what our job is. We facilitate it. It's required in the tax code by the IRS to have a qualified intermediary. I just call that job security. And my little background is that I've been doing this with IPX now since 2009. What is that, 15 years? Is that, I'm doing the math right? And before that, I was partner in another company for about 6 or 7 years. Prior to that, in a completely different life, I was an investment banker. I did M&A work, mergers and acquisitions with Merrill, and before that with Credit Suisse First Boston.
Well, and as I remember in talking to you in our past, you have a CPA background too, perhaps? Are those some of your credentials?
Masters in accounting.
Masters in accounting, right. So you have this deep credential, which is interesting. It gives you this fascinating and unique position for which you can take in advising your clients who need to complete a 1031 exchange.
Well, it certainly does help, but one of the weird things about our job is that we can only address or talk or give advice, so to speak, within the narrow purview of the 1031 exchange. So I can't actually calculate their taxes. However, the one reason I think people use me as opposed to somebody else is that I will go that extra mile, that extra step. I'll help figure out their basis and their gains and what their resultant taxes might be. Then they can see the value proposition in doing an exchange as opposed to just selling.
So give me a simple residential opportunity. Let's pretend, the bulk of my clients or people who are listening maybe are a small time investor outfit who has a couple of rental properties. Give me a scenario in which they would use a 1031 exchange.
Sure. Let's say this is a very common example. Somebody has lived in their home and they decide to move out, but instead of selling their home, they keep it and they rent it out.
Yes.
So now they're in the rental income business. After renting it out a year or 2 or 3 or whatever the case might be, then they decide, I'm going to sell what used to be my home. Now it's a rental, and they don't want to pay the capital gains taxes. So that's when they call us, a qualified intermediary, and then we do the documents that the IRS requires. And they can sell, not have to pay the taxes on the gains, and go take their money and go put it over into a replacement property and do it all over again.
Right. And one of the fine points to that is they can't touch the money.
Yes, that's right. So at the closing table, normally someone selling their property, whatever it might be, they usually walk out of that room with a nice big proceeds check or have it wired to their checking account, but not in a 1031 exchange. Instead, whatever those net sales proceeds are have to be wired from the closing table to us, the qualified intermediary. And by law, within the tax code, we're required to hold on to those proceeds for the duration of the exchange until they're ready to go buy that next piece of property.
And so they have to replace it into real estate. And there's a couple simple rules.
Any other real property.
Okay.
So again, hopefully I'm not stepping on what you were going to ask me there. It can be any other type of property. If they sold a rental condo, they don't necessarily have to buy or exchange into another rental condo. They could buy a single-family home or land or commercial office building or strip shopping mall. There's a whole wide variety of real types of property that they can exchange into. They can even do something more esoteric. They can exchange into oil and gas or water rights or air rights. So all that is available to them.
Right. And so there are some strict time limits that the IRS imposes. What does that look like for a simple residential deal like this?
The day that they close on their sale, that's the start of their exchange. So the 1031 stuff, the exchanging, doesn't start when they go under contract to sell. It does not start when they get an earnest money check from an interested buyer. It starts on the date of closing. So from there, they get two timelines. They get 45 days to identify. So we literally give them a form and they write down the addresses of the properties that they want to buy.
Right.
The other timeline starts on the same date, the day they close on the sale. They get 180 days to close on the purchase of one or more of those properties that they identified in the first 45 days.
Do you have to identify a specific number of properties? Is there a minimum or a maximum number of houses you can identify? And what happens if those sell before they can get the money parked? How does that work?
So if they don't identify anything, like they can't find something or they just don't identify, then their exchange would fail. They get all of their net sales proceeds handed back to them on day 46 after the day 45 of identifying, and their exchange fails. Is there any penalty? No, there's no penalty. They just end up having to pay the tax, so they're no worse off than they would have been before.
Right.
Now, the other part of your question is, if they do identify something, how many properties are they allowed? The answer is 3. So they can identify properties A, B, and C. And so now they're a week or 2 or 3 down the road inside of their 45-day window.
Yep.
And A and B and C are not going to work. What happens? Because they're still inside that window, they can give us a list and identify new properties, like properties 1 and 2 and 3.
Right.
So the point is, how many times do they get to change their mind? And it's unlimited.
Up until the 45th day.
That's right.
I got
it.
So
a lot of people, most people actually, don't even turn in their list to us until they get to about day 45.
Sure. Right. They're kind of waiting to the end.
Because things are changing.
Right. To make sure, particularly, and so the market conditions are moving some of this for the buyer.
Yes.
Because as they're watching the market, if something goes under contract and they want to identify. Right. That's right. Okay. So we know that the federal government has given us this tool, this 1031 exchange tool, and there's these sort of strict guidelines around it about the timelines in which people can sell their old house, or what you call the relinquished property, and place it in the replacement property.
Very good, yes.
So I think I'm sprucing up on my 1031.
No, that's all right. You're an experienced pro.
That's
you know
right.
This stuff.
Something like this. So maybe tell me a scenario in which you really feel like the work that you've done has just meaningfully changed somebody's life, and what did that look like?
That is a good question. I'm going to have to just ponder that for a little bit, because I run into all different types of sellers, all different types of exchangers and taxpayers. It runs the gamut from people that are maybe a little bit older, and this is their big nest egg. They've got a lot of money tied up in real estate, and they don't want to lose it. They don't want to pay the capital gains taxes. They want to exchange maybe and not necessarily buy more real estate, so they can buy other types of property, triple net leased or property, or DST. Those are very passive investments. Other types of folks that do exchanges call me up and they're struggling or striving to find a property that's going to be closer to their son or daughter so they can be near the grandkids. That's the one that probably strikes emotionally big time with me, because I want to make sure to help them to get there so they can do that, be with their grandkids. Yeah. Other times it's just larger investors or larger companies or corporations that are doing an exchange, and that helps their employees.
Sure.
So I don't know, am I hitting?
No, but I mean, I think that's true. It's a very technical business, and what you do is very technical work. But I mean, behind all of it, there are real consequences, real significant savings, both for business owners, for property owners, for people who are doing the exchange. And there's always a human behind the technical piece of the work that you do.
Very true. Very true.
So you have a team.
Yes.
Tell me about how it would work. If I brought my exchange to you, what does that look like?
Sure. I'll try and answer from the top down. How about that?
Yeah.
So IPX is a group of maybe 30-ish attorneys and CPAs, and including the banking staff and the exchange coordinators and other people like me, we might be 175 some full-time employees. So we are wholly owned by Fidelity, Fidelity National Financial, not Fidelity Investments. So Fidelity National Financial owns Fidelity Title, Chicago Title, Commonwealth Title, Alamo Title. That's a big deal down in Texas.
Got it.
So that's the big umbrella picture. Our team is that my business partner, Danita Vigil, who has been in the title insurance business for a long time. Yeah. If I said a number, she'd probably yell at me that it was either too big or too little.
Yeah.
And she came over and has been working with me and helping do 1031 exchanges. I also have 4 exchange coordinators. I've been lucky enough to stagger one in each time zone so I can do nationwide exchanges.
Great.
Also have a reverse exchange group for the Mountain Region. It's an attorney, Mark Bullock, who's part of our firm, part of the Mountain Region, and his coordinators. So that's a team of, 6, 7 folks?
Well, just really quick for the high-level learner.
Yeah.
What's a reverse exchange?
Cool. I think the best way to do is compare and contrast it. A regular forward exchange is where the client says, I'm going to sell my current property that they own. I'm going to call it the old property. But you were right. You called it the relinquished property. That's the right name. Mm-hmm. They want to sell it. Again, they've got 45 days to identify. They have 180 days to buy the new replacement property. Old property, new. In a reverse exchange, for whatever reason, maybe the client just wants to do the following, or maybe they're forced into this situation because of the real estate market. They'd like to buy the new property first before they've got that old one sold. And in today's market, you can see why they want to do that. Almost half of our volume is now reverse 1031 exchanges.
That's right. It gives you sometimes people want to know what they're buying before they let the old one go.
Absolutely. Yes. So in a reverse exchange, I'll tell you the wrong way to do it because then the right way makes a lot more sense. If the client finds some new property that they like and they do indeed buy it, yay, now they own it, but they still are entitled to the old property because they haven't sold it yet. The IRS says you're entitled to both at the same time. You can't do an exchange between them. So they created this bit of fiction, this creative part of the tax code called a reverse exchange. And instead of the client buying their new property, it's actually going to be us, the qualified intermediary. We have to use a special purpose entity. That entity will step into the client's shoes. In other words, we're assigned into the purchase contract, and we will buy the new property, not the client. We own it, not them.
Right. You can think of it like a trust or an LLC, essentially.
Yes.
Creating a business.
In fact, most of the time we do use an LLC to park title. That's what it's called.
Great.
So the day that we do that starts the reverse exchange. They get 180 days to do 2 more things. Somewhere in that ensuing time period, they have to get their old property sold.
Yes.
Those monies, those sales proceeds come into the exchange, and then usually the same day or maybe the next, we transfer ownership from us to them on that new property that we had parked title to.
There's a cost difference to do a forward exchange and a reverse exchange.
You can see that reverse is a lot more complex.
Well, right. You're setting a business
They're
entity
about
up.
$5,000 or $6,000, something like that.
Okay.
A regular forward exchange, what you sell is $950. When you buy something, $250. So it's a grand total of about $1,200. Mm-hmm. But here's my motto. I never want to lose an exchange simply because of the fee. I will always work with a client to make sure we can get their deal done.
You're dealing with somebody who perhaps is saving hundreds of thousands of dollars and potentially more than that on a big exchange in taxes. The $1,200 or even $5,000 for a reverse exchange for the right situation, that's a nominal amount of money in the grand scheme of life if they were going to pay the IRS something substantial.
You are correct. I need to get a little small 1-minute video of you and put it on our website. That's a good sales bit. That is very true.
Yeah, it's a nominal amount of money, and that's the reason people do them. Is really a tax saving effort.
Very much so. Yes.
So people often ask me, how much am I going to pay in capital gains? And I know you don't do that calculation, and I always have to sort of thump them over to their CPA, or the CPA in theory is the right person to help them do that calculation, or your company has some of that, the ability or bandwidth to do that. But how do I know if somebody is going to pay 15% on their gain, or 20 or 30, or maybe that's a complex question, but can you distill it down?
We can break it down, and I think understandable. When somebody sells their investment property, and let's say they've owned it 5 or 7 years or 12 years, whatever the case may be, when they sell, most people don't realize that there isn't just one gain. The one gain everybody thinks of is, oh, hey, my property went up in value, so I'm going to pay capital gains taxes on the appreciation, which, by the way, is either 15% or 20%, depending on their adjusted gross income. But there's a second gain when you sell investment real estate. There's the gain from the recapture of depreciation. That depreciation expense taken each year builds up. That accumulated depreciation is treated as a gain.
Correct.
When they sell the property. And it's taxed regardless of the client's income level at 25%. So we have 2 gains and 4 taxes. There's the 15 or 20% on the appreciation, 25% that we just talked about on the depreciation.
That's the recaptured depreciation. If
Correct.
somebody cost
Section
segregated a
1250.
property, they would have to recapture all of that.
That they have
It would be
taken
taxed
on
on
the
all of
property.
that recapture.
Yeah.
Okay.
But if they do an exchange, then no, it's rolled forward into the next property. So both gains can be rolled into that next property, which is the goal of doing the 1031 exchange.
So let's go back to that residential investor, maybe the older client who wanted to do the 1031 exchange. How do they get out of this trap, basically, in the end? Or can you ever
That's a
get out of the
great
trap?
question.
And so how do people either come out of this tax-free in the end, either by,
There's a couple ways.
means or high water? Okay, well, go ahead then, please.
You bet. So what you're asking me is, isn't the taxpayer just sort of kicking the can down the road? Someday they're going to end up having to pay the tax. Not necessarily. There's a couple of ways that they can get out of paying capital gains. One is, to be sort of blunt, is they can die. Because when someone passes away...
Well, that's the only thing that's 100% sure for all of us, right?
That's right. And taxes. Death
and taxes. Got it.
And I'm taking
And
care
you
of the
do both.
tax part.
Okay. Yeah. Oh, right.
So
the
when
taxes may kill them, but I mean, it's fine.
Yeah,
No,
there
I'm
you
just kidding.
go. Wow. Okay. This interview has turned dark right here.
No, I'm teasing.
So when someone passes away, all of their assets, particularly the real estate investment, the basis in the property steps up to fair market value on the date of their death, meaning that all of those gains are erased. They're eliminated. So whoever their heirs are, their kids or nieces or nephews or whoever, can, if they want, sell the property and pay no capital gains taxes. So in our business, to continue with a grim little bit of humor, we call it swap till you drop.
Right.
Do an exchange until you pass away.
That's right. What if you're married? Do you get the step up in basis on an investment property?
In Colorado, a non-community property state, you get half the step up in basis. Whichever spouse passes away, that's the basis that gets stepped up.
Got it.
So I said there were 2 ways to get out tax-free, so to speak.
Yeah, death is one.
Death is one. The other one is to do an exchange and buy what many people would call their dream home. So you do an exchange, maybe you've done one of them, maybe you've done 2 or 3 or several, and the last piece of property, you can do this little bit of magic. So it does not have an actual name in the tax code. I just refer to it as a magic trick. So the property that you buy, that you're going to do the magic on, has to be residential. So it won't work if you're dealing with a strip shopping mall or raw land. It's got to be residential.
Yeah.
And 2, you've got to own it for 5 whole years. And bullet point number 3 is the first year, sometimes tax advisors will say the first 2 years, you have to rent it out. So you do the exchange, you buy the property, rent it out. But after that first year or 2, you can then safely move into the property without damaging your previous exchange. And now you're going to live there and turn it into your personal primary residence, your home.
That's right.
So later on, when you sell the property, guess what you get to do? You get to use your exclusion. If you're single, the maximum is $250,000. If you're married, the maximum is $500,000. So you're going to turn some of those deferred gains into tax-free dollars.
That's right.
Caution, just in the interest of being clear here on the podcast, you don't get all of your $500,000. You don't get all of your $250,000. You get some prorated amount of it. It's called the qualified use. And we can go through the math later, but it's a little technical for here.
Yeah, but this is great. I mean, this is the way.
Oh, it's much better than having to die.
Yeah, well, it's better than having to die. I was going to say alternate B is you move into it.
Yeah,
and
your dream
you
home.
eventually, yeah. So I do see people doing this where they'll take maybe even 2 or 3 rental properties.
And use all the combined monies to buy a much bigger, nicer property and then do this magic trick. Yes.
But the magic trick, the other part of the magic trick is you do have to rent it.
For the first year.
For the first year.
Yep.
And I guess the question is, when you're doing the magic trick, does it matter what you rent it for and to who?
It does. Sometimes people, particularly in the old days, would rent it at some exorbitant fee. If it would really rent for $2,000 a month and you advertise it for rent for $10,000 a month, you can't do that anymore.
Oh, you mean trying to just say they were in pursuit of a tenant?
Yes.
They were in pursuit of a tenant, which they could never find for a year and a day.
Exactly, yeah. They keep out the riffraff that way.
Or renting it for $100 a month to their Uncle Clark.
Well, that wouldn't pass muster either.
I got it, right. So the idea is you really have to rent it.
You do.
You really have to rent it for a year and a day.
Treat it as an investment rental property.
That's right. So tell me, what am I missing about 1031 exchange? What's another, what haven't I asked, or what's on your mind, or how else do you like to talk to people about exchanges? And
Sure. There's a couple of things. So continuing on that vein that we were just talking about, exchanging into what might be someone's dream home, there are a lot of people that will call up that are a little more senior in life. And they want to do an exchange because nobody likes paying 30% capital gains taxes. But they also don't want to buy more real estate.
Right.
I mean, it takes up time and energy. And so there are passive investments that they can buy or exchange into. DST product, Delaware Statutory Trusts. Think of it sort of as a fractional interest in a very large trophy-sized property. So the exchanger is buying a sort of a fractional interest. It's really a beneficial interest in that larger trophy piece of real estate. So it's very passive. They don't have to deal with maintenance. They don't have to deal with shoveling the snow off the sidewalk. They have reasonably good rates of return. It has all the same tax benefits as owning regular real estate. But the main thing is it's passive.
And on a DST, if you do a fractional exchange ownership, do you get a monthly check or quarterly checks? How does the money
Usually
come
it's
to the
monthly, yeah, and it's net of all the expenses. So a lot of people call it mailbox money.
Sure.
They just walk out to the mailbox and they're getting their monthly check.
Right. Instead of owning toilets and tenants, right?
Yes.
That's what
So you've heard that sales pitch before.
Mm-hmm.
Toilets, tenants, and termites you don't have to deal with.
That's right.
So it's very, very passive, which is a very nice thing for someone that wants to do an exchange but not end up owning regular traditional real estate.
I'm curious, just, as another aside here, the real estate money can be parked in this account with with the exchange account.
Yep.
Can people buy stocks with it or put it into a mutual fund? Is there any place else they can park it? I know that you talked about mineral rights and oil and gas rights and some other things like that, or the DST. Right. But I'm curious, what about a stock?
Yeah, the answer is no. If we were able to do an exchange and sell real estate and go buy the stock market, we'd be at 50 million on the Dow or something like that. No, it's only for real property or real estate.
Right.
That's the only thing you can exchange into. Oil and gas and water rights and mineral rights all fall into that because they're considered a part of real property.
Right.
A lot of people hear about REITs, real estate investment trusts.
Right.
And they say, hey, can I do an exchange into a REIT? And I say, no, you can't. Why? Because it's exactly as you had said previously, it shares a stock, and that's not like kind to real estate.
Right.
So is there a way to get into a REIT eventually? Yes. You do an exchange, sell, and buy DST, but not just any old DST. Buy one that it's sort of targeted, that it will be later on down the road acquired by the REIT, and there's a special type of REIT called an UP REIT, umbrella partnership REIT. And so you do the exchange. That would be a maximum of 6 months. Then you have to own it for a year and a half, typically is the time frame. Then at the end of that, so now we're at 2 whole years, it can be uploaded, contributed under Section 721 into the REIT. And there you are. You finally achieved your goal.
Yeah, it's a way, to exchange real property
eventually into a REIT.
Into the REIT.
And you're out of the real estate game. Because now you got shares or operating units of a REIT. If you sell them, it's a taxable event. Can you do an exchange? No.
Okay. So it's really an end game tool.
It truly is an end game.
The REIT is an end game tool. Okay. What other of these little tricks do you have up your sleeve?
There's a lot of times investors will come to me and they own the property that they're selling, that they want to start the exchange on, and they own it in an LLC or a partnership or some other ownership entity, and some of the partners want to do an exchange and the others say, nah, I just want my money.
Right.
So there's several different strategies and structures as to how to get them out. That's another hour-long podcast.
Right, about how to get a partnership unraveled.
Unraveled is a good way to put it, yes.
Part can exchange.
And to do it correctly so that the IRS does not attack the exchange.
Correct.
Yeah.
Because there are ways you can fail the exchange and the IRS would come looking for you.
Absolutely.
Uh-huh.
I mean, remember, the number one goal of the IRS is to get their tax money. So they're looking for any little tiny screw-up so they can get it.
When they come looking,
yeah,
does that mean that you would have to be audited for them to come look? Or, I mean, how do they find? Are they getting this? Are they getting copies of all this? They're looking for mistakes on your part? They're looking for mistakes on the owner's part?
Great question. It has a little bit of a nuanced answer. So how does the IRS know that you sell real estate? Well, as you know, because you've been to several closings in your career.
Just a couple.
That there's a 1099-S for the sale of real estate generated by the title company and sent right off to the IRS.
Right.
So the IRS knows that, Mr. Jones just sold property XYZ. So that's one way that they're looking or already tuned in.
Right.
The other way is that when you do an exchange, there's one little piece of paper you have to file with your tax return, Form 8824. And that also tells the IRS, hey, I just did an exchange. You guys don't get my capital gains taxes this year.
Right.
So they track it by the 1099-S, they track it by the Form 8824, and if something goes wrong, if they don't see income, if they don't see expenses on your tax return, on your Schedule E or whatever that might be, then they might come knocking on your door.
Have you had clients who have been, personally investigated on their 1031 exchanges?
Not very many, thankfully.
Okay. So this isn't a common thing where it's like they're looking for you.
Yeah, you would think, is there some sort of percentage that we know of that the IRS goes? We don't have any statistical evidence. There was a study done a long time ago, way back in 2006, I think it was, Department 5 of the Treasury. And they said back then it was about 6 or 7% of all the millions of exchanges were audited. I have no idea if that study is applicable at all in today's world.
Sure.
But it's some small amount, but when they come knocking on your door, you get the letter in the mail, it feels like the world has just crashed down around you.
Oh, I'm certain of that,
So
yeah.
you want to make sure that you get someone that does it right.
Do you have an idea or a concept of how many people are going through IRS audits outside of the 1031 exchange? Do you have an idea of what that number looks like?
For a standard, regular 1040 tax return, the number is about 2.5%. But, if you get a CPA listening to this, if I'm off by 0.5% one way or the other,
those analysts, they're always analyzing the numbers, aren't they?
That's about right.
Awesome. Okay, we had a friend of probably both of ours, Dwayne Duggan, on the podcast, and he talked about buying a single family home, exchanging it into a duplex, exchanging it into a fourplex, exchanging it into an eightplex. He says 32 is the right number. That sounds like a lot of rental doors. But you have clients who've done this before, right? People who've exchanged up
they get
over the years.
Bigger and bigger. Yes, that's true.
Do you feel like there's a threshold there? Like, where do you feel like the sweet spot is, just on your experience? Or
Well, it depends on the investor. Some investors like pursuing that sort of thing. When the property gets bigger, you got more things to deal with. Mm-hmm. Some people don't like that. Maybe there's a limit to what they do or don't want to have to tend with. So every individual is indeed individual in what they need or want.
If people have questions, can they just simply call you and Danita, your partner?
Oh, yeah.
And I mean, you guys have been available.
Our consultation is a part of our service. That's why people use us as opposed to somebody else.
Yeah.
We'll talk them through just very similar to what we're doing here on this podcast.
Right. Yeah, I mean, I have found you've been such a valuable resource for me. I'll have a technical question or this little nuanced thing or a client that really does need you. And I find, just to be able to call you and to ask you just a simple question about a 1031 exchange. And I have had quite a few clients in the last, couple years who've used your services. I mean, your team does a fabulous job, really. And your wealth of knowledge is insane, truly. I mean, you do know a lot about this process. It's been really pretty cool. I want to switch gears a little and just tell me a little, I feel like the 1031 exchange is always legislatively on the chopping block?
It feels like that.
Why? And is it really on the chopping block, or do people who know these things,
yes,
do they know something that we don't?
It's been on the chopping block for sure since 2009. So it's been almost like an every other year, certainly every presidential 4-year cycle, it's on the chopping block. Why? Because a lot of people don't understand it really, and they view it as a way that, rich people are not paying their fair share of capital gains taxes, which couldn't be further from the truth. So they go after it. They think of 1031s as if it were a loophole in the tax code. It's not. It's a direct replacement of real estate. It's a way for businesses and small investors and larger professionals to grow the portfolio, to grow the wealth of real estate in the United States. And so are 1031s currently on the chopping block? Yes, the current administration, Biden-Harris, and the candidate running, so what would it be, the Harris-Waltz, both of those want to eliminate, not just limit, but eliminate 1031 exchanges from the tax code. So one of the proposals a couple of years ago was to restrict or limit the exchange to no more than 500,000. They've dropped that, and now they want to completely eliminate the Section 1031. So why? Well, they view it as a way to get more money. But can I throw some numbers at you?
Please.
All right. So in the United States, so this is a study that was commissioned for Ernst & Young, one of the big four accounting firm. And here's some of the stats that they found. So 1031s created almost 1 million jobs, 976,000 jobs in the year 2021. In the same year, 21, the 1031 business created almost $49 billion in labor income. When that same year, about $98 billion was contributed to the United States' GDP. So the tax revenues that exchanges create, call it $19 billion in round numbers. If they eliminated 1031s, how much would they get then by eliminating it? Only $1.9 billion. In other words, leaving 1031s alone so that it grows the economy, it helps tenfold.
Right.
Just to leave 1031s alone.
Right. And so
I hope all those numbers made sense.
No, well, yeah, I mean, you got whatever that is, an $18 billion discrepancy.
That's right.
Between letting the industry do what it does and going straight away and cutting it off at the knees and collecting the straight tax revenue off of those sales. It just...
Think about this. I'll divide between residential and commercial. So in the residential world of all the different sales, 1 in 5, that's 20%, of all sales closings are driven by a 1031 exchange. When I first heard that number, I was a little like, really? That sounds pretty dang high. But then you think about all the rental homes that are out there, rental condos, or vacation home property that's there. On the commercial side, 1 in 3 commercial closings, sale closings, are driven by a 1031 exchange. When you get larger properties above 10 million, that number becomes almost 50% being driven by a 1031. Think what would happen to the residential market, or what would happen to the commercial real estate market, which is under serious strain right now.
That's right.
If they eliminated 1031 exchanges, it'd drive real estate to a grinding halt.
Well, that's right. And you just take the commercial piece of that with 1 in 2 or 1 in 3 of those properties being bought and sold inside the 1031 code. You eliminate that. What does that do to the actual fabric of those communities? If business owners who own those little commercial spaces that you drive past, forget the big commercial buildings,
strip shopping malls,
all the strip shopping
tiny
malls,
office
all the
buildings.
daycare buildings, all the Starbucks that we like to get, all of those are being constantly exchanged on a commercial level.
Which improves the property, makes them better, because every new owner improves it. Without that, you're looking at neighborhoods that could really go south.
Can you borrow additional money when you're buying? So let's say somebody had something small and they wanted to buy a Starbucks.
Yeah.
They could add money to it?
Oh, yeah. So they sell whatever it is they sell, their old property. They've got X number of dollars coming out of it. But that pile of money is not enough to go buy the next property. Maybe it's another single-family rental house. Maybe it's a Starbucks, whatever. Can they add some of their own money to that purchase? Yes, certainly they can. Yeah. Or they can get a loan. Or or they can do both.
So, I mean, this is such a powerful tool that is under assault.
Yep.
And you are such a brain with this. It's just remarkable. And you have such a great team.
Yeah.
What else do you want people to know about 1031 Exchange or about the business that you do? And leave us also with a place for people to be able to reach you, to call you and email you.
Go visit our website, IPX1031.com. It's a great resource. You can find answers to almost any 1031 exchange question you can think of. But one of the main things about it is, as a resource on the homepage, you can generate a letter to be sent to your congressman or sent to your senator. It's already written out for you. If you want to change it, you can. Don't add swear words or anything like that. And then based on your zip code, you click submit, and it gets sent right off to them. Believe it or not, the congressmen and their staff, senators and their staff, they pay attention to this, more so than even hard copy letters. So the more times we can email them, more time that they hear from clients out there, the better off I think the results will be. So we have successfully defended 1031 exchanges now since 2009. And that's not just IPX, but all different qualified intermediaries, National Association of Realtors, NAR, NAIOP. I mean, I'm trying to list all the different organizations.
Yeah, but there's a lot of powers that would like to see it stay in place for the benefits that you described.
Absolutely, yes, and rightly so.
And the small consumer benefits greatly from your larger voice, from your
That's
advocacy.
something that a lot of senators and congressmen don't seem to understand. Again, they think it's either a tax loophole, or they want money, or they think it's only for the big people, the wealthy. Not true at all.
Oh, not true at all. Many of my clients who've done an exchange, in fact, I would use the word all of my clients who have done an exchange with your company, are small guys. They're not big guys. And the exchange, yes, has benefited them tremendously. So if you could leave us maybe with a piece of advice for somebody, or for somebody who maybe has an interest in your field, what would that be?
Piece of advice in dealing with the real estate, start sooner rather than later. So call us way in advance if you can. I mean, sometimes things just happen to you, and you have to sell by the end of next week or something. But call us sooner than later. And again, talking to us, myself or Danita, it's all a part of our service. Not a lot of qualified intermediaries do that.
Right.
So, and if you're a real estate agent and you barely remember the words 1031, and you're going to meet with a client at 3 o'clock in the afternoon, call us up. We'll give you a 5-minute refresher so that you can go to that client meeting with confidence.
That's right.
In fact, if you're sitting at the client meeting, it's okay, call us up, put them on speakerphone, I'll help you through it.
That's awesome. Well, thank you so much for coming. And
well, thank you.
Yeah, and I feel like we could do like a 201. I feel like we need a 201 version of this coming up. And so we'll have you back to do that another time.
That's very nice. Thank you. I look forward to doing that.
Thanks, Tracey. Bye.